Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Facts versus Feelings, episode 19. We are back in, our offices. Last week we were on location looking for Warren Buffett. We'll talk about it in a second, but this one is called So Goes January. So, Sonu, how fun was that, searching for Warren Buffett? We didn't find him, guys, if you listened to the last one, but that was a good time, right?
Absolutely. Like you said, the disappointment was that we didn't find him, but hey, we had a good time.
Yeah, we had a good breakfast too. I
Yes.
haven't had McDonald's breakfast in a long time. I see why Warren Buffett does that. If I were the richest man in the world, I'd probably eat like that every day also. So can't blame him. Well, Sonu, we've got a lot to discuss. Again, we're calling this one So Goes January. We'll get to it, but there are some compelling data that when January's strong for stocks, like we are seeing, we are recording this on the last day of the month, but we're likely going to finish up with a really strong first month. What could that mean? We're also going to take a look at what changed. That's our first question. What in the world is different? Because this last year was rough across the board. Now stocks and bonds are doing just fine. So we're going to dive into that first. Second conversation, we're going to take a look at kind of the economy. Sonu, you've done some great work on GDP, CapEx. We're going to take a look at maybe how earnings season's been so far, kind of massage all that. And then the final discussion, again, so goes January, goes the year. So Sonu, first things first, what did change? We're like up 6% for the year on the S&P. I think it's close to 9% for the NASDAQ, a couple percent for the Dow, but Dow did great last year. Stocks are up across the board. Bonds are up across the board. Is it as simple as the calendar changed and all of a sudden everything went up? What in the world's different the last 4 weeks?
I mean, there is that too, right? The calendar and the seasonality, which you've written a lot about. This is a positive period, right? But I think 2 words, inflation's falling.
There you go.
That's it. I think that's what's, I mean, we've talked about that it's like, what's changed in our minds, you and I, we've kind of expected this, right? We didn't think inflation's going to go up, but it seems like I think everyone else is recognizing that.
Yeah, just this morning, I know you've had a chance to dive in. The ECI, which I believe is called the Employment Cost Index, came in lower than expected. That's what people are, employment, how much it costs to get somebody. The Fed and the government, they want to see that number down. We've seen inflation across the board. We talked last week, I think, about the PCE. If we didn't, PCE came in low. We've seen low inflation across the board. Talk to me about that ECI and why that one matters to the Fed. Because honestly, it's real quick, but futures did pop this morning on that lower than expected ECI report.
And we're doing this for Jan 31st, right? It's like the last day of the month. It's been a really super strong month. And so hopefully we end the month, in a good way. So fingers crossed for that. And look, the ECI it's kind of like an economist's favorite indicator. And I include the Fed in this as well. Why? Because it tells you about how wages are growing or falling across the economy, right? Now we have other measures of wage growth, right? You get the non-farm payroll report month after month, and you see this thing called average hourly earnings. But that's just an average across every industry, every job there is, right? Within the surveys and things like that.
And now, full disclosure, so I'm just going to jump in. That came in better than expected last month. That's why we had a big rally. It was Goldilocks we talked about, but that was lower along with this one. So we're seeing employment come down, or employment costs
and
come down.
Almost every measure, right? But the thing is, everyone likes the ECI because, if you think about average hourly earnings, what happened during COVID, interestingly, average hourly earnings went up. Why? Because a lot of low-employed, low-salaried people lost their jobs. So the average went up, right? So that's why, economists like to look at the ECI, the Employment Cost Index, because it controls for that, right? So it's like a much more stable measure of wage growth. But the problem is it comes out only quarterly. Right. So every time it comes out, it's a big deal, especially recently. It never used to be that big a deal because wages are growing about 2-3% or so. But now it's decelerating. That's huge.
Let me jump in. I think the reason I think it's a big deal, because I've done this for over 20 years. And to be honest, I never really heard about this that often. But Jerome Powell actually specifically mentioned this, I forget, several quarters ago, right? Now it's on all of our radars. And hey, it's a Fed decision tomorrow from the time we're recording this. So we know Jerome's watching that, right?
No, absolutely. You think about the Fed raised rates, Brian, 75 basis points 4 times last year, right? Which means even in their minds, they were behind the curve, right? They were playing catch up. right? So it's almost an acknowledgement that, oh, we didn't raise rates fast enough. Now, why didn't they do that in 2021? Because wage growth was not high enough, right? Inflation is still high. If you remember, yeah, inflation is like 5-6%. But they were like, you know what, wage growth is still sort of tame. We don't have to worry about that. And then suddenly in November of 2021, the ECI came out, and that's when Powell switched. It's like literally a light switch. He's like, oh my God, we're worried about inflation now, right? That's when yields started going up. And then they just started, like really panicking by the time we got to June of last year. So exactly. I think the ECI is, good news with ECI. This gets to how the Fed thinks about this stuff as well, right? For them, in their mind, it's their model, right? For inflation to come down, it's not like you and I we look at the micro data. We're looking at rents, we're looking at gas prices, food, all of that, right? For them, it's like, it's connected to wages, which I'm not saying that's wrong, but that's the model they have. It is what it is, right? We got to follow what the Fed follows, right? If wage growth is high, that means, people go and spend more of their wages on stuff, and that's going to put pressure on prices and inflation go up, right? That's their model. The thing is, they believe for inflation to come down in a persistent way, for it to stay lower, right? Not just come down temporarily. For it to stay low, wage growth has to be lower, right? For that, what has to happen? The employment market has to soften. Basically, it means the unemployment rate has to go up. What's amazing right now is today's ECI number came down, right? It's decelerating, and we're at 50-year lows in unemployment, right? This goes completely against their model. Right. But again, like I said, if you look at the underlying data, look at rents, look at gas prices, food prices, used cars, all of that stuff is coming down.
And we've been talking about those for several months. And that was one of our big drivers of why we thought stocks, we talked about in our outlook 2 weeks ago, why we thought stocks would have a really strong year this year, because inflation's coming back quicker than most people expected and most people think. Now, Sonu, you did something. I would get too geeky with this. You do a daily note for our partners and advisors here at Carson Group. And you pointed out that once a year, the government changes the components to CPI. And apparently, used cars, which have been coming down big time, we've been talking about it on this podcast, I feel like every single time for several months, used cars are counting less now. I don't even know what to make of this. I mean, maybe we don't know the official how they're going to change it, but I don't know. Talk to me about what in the world that means. What in the world does that mean when you change the inputs to CPI?
So this is one reason the Fed actually prefers the PCE index, the personal consumption expenditures index.
Me too. Me too after hearing this. Yeah.
So the CPI basket, there's a basket of goods, right, that they track over time, and that's how they figure out, price is going up or down, right? Now, they used to change the composition of the basket, like gas prices are like 4%, used cars are like 3.5%, 4%, new cars are somewhere around there as well, right? So they used to update these weights once in 2 years. But last year they switched to, like they said, we're going to an annual update right now. So a little better. Now, they have their own ways of doing this, coming up with the weights. We don't know yet what the weights will be, but there's fair idea that, the weight for rents are going to go up. And guess what? Rents are going up right now. We know it's going to come down, but it's just the way the government measures rental data. For now, in the official rental inflation data, it's still going up, right? But the weight for rents in the basket is going to go up. The weight for used car prices, which are coming down, that's going to go down. So what's going to happen mechanically, not because of anything happening in the economy, mechanically just because of a measurement issue, the way they measure things, inflation's probably going to go up a little bit in Q1. So I have a feeling everyone's going to look at it and like, oh my God, inflation's going to go up, right? But this is solely a measurement thing. It's no reflection at all as to what's happening in the economy.
Right. So you heard it here first. Facts versus feelings with Ryan and Sonu. There's a change to CPI. So when that comes out in a couple of weeks, maybe we shouldn't panic too much about the high inflation. Sonu, so I'll chime in because we need to move forward. What is different? What changed to start this year? Guys, this might be a little surprising. I don't think too much changed. Here's why. We think stocks bottomed in October. Remember, we made 2,000 stocks made new 52-week lows in June, retested those lows on the S&P 500, broke it by a tad on October 12th, October 13th. And then we've been very strong since then. We've seen really strong participation. More than 70% of the stocks in the S&P 500 as of yesterday were above their 200-day moving average. That's another bullish thrust. We talked about all the strong breadth before on this podcast. We continue to see that. So yes, January's been a great month. But we've been seeing some strength really since the October lows